Welcome to the video on insurance. This is the first lesson in this unit, so it's just an introduction. Lots of vocabulary to start. An insurance agent is a person who represents an insurance company or possibly several companies at one time. The insurance policy is a contract between you and your insurance company. It is enforceable for something of value. So it is a binding contract, and this is essentially what you are purchasing from the insurance company. The policy term is simply the length of coverage provided on a policy. The declarations page is something that gets sent to you in the mail, normally after you sign your policy, and it's also called a binder, but it pretty much just breaks down the coverage on your policy, how much each line costs, and the total premium. Line is just like the type of insurance, because you can go to one company and purchase several different types of insurance. So the declarations page is really just a breakdown of all of those costs and coverages. There will be exclusions to a policy, and so that's what the policy does not cover. And this is going to be clearly listed on your policy, possibly your declarations page. But for example, this is like how an earthquake damage or damage caused by an earthquake would not be covered in an area where there are few earthquakes. So you wouldn't think twice about it because, of course, well, I don't live where there are earthquakes. Why would it be covered? But the insurance company needs to make it very clear that if there happened to be an earthquake by some freak of nature, they are not going to be able to pay the coverage for that. The premium is just what you pay to the insurance company. It is the bill. Most insurance companies will break it down by month, and they will also give you an early pay discount. So if you pay in one lump sum, it's normally a little bit cheaper. It's not a credit, but some companies will offer a cheaper discount if you pay in one lump sum. But your premium is going to be calculated based on how much of a financial risk you are to the company. So a higher risk is going to cost, you're going to charge more, they will charge you more than they could be charging your neighbor simply because you might be of a higher financial risk. And we'll talk about that a little bit later. A deductible is the amount of money you have to pay before your insurance kicks in. You do agree to this amount before buying your policy, so this is something you do need to consider whenever you are just living your day-to-day. If your deductible for your car insurance, for example, is $500, it's always a good idea to have at least $500 in your savings account, because if you were to get in an accident where even your car is completely totaled and the insurance company is going to pay thousands of dollars to replace your car, you will still have to pay $500 out of pocket because that was the deductible you agreed upon. The higher the deductible, the more you are willing to cover to begin with. That will often lower your premium from the insurance company because they think that it's valuable that you are going to be willing to pay more money up front. The claim is what we call the accident or incident that happened. That's what you file. So if something does happen and you call the insurance company, you will get a claim number. And so that's just how it's referred to from there on with the insurance company. And a quote is what the insurance companies estimate of what they can offer you and what it's going to cost to you. So let's say there's damage to your house and they think that it should only cost $5,000 to fix it, and that's what they're willing to give. But if the roofing company says it's going to cost $7,000, then you might have to pay $2,000 out of your own pocket. And then obviously the deductible would be discussed there too. But the quote is just the insurance company's estimate of what they can offer you. Lastly is annuity. This is an option for how the insurance company pays you. If it's a specific incident or accident where like you just have damage to a house or to a car, most of the time the money is just paid in one lump sum, either to you or maybe to the company that is doing the work. But there is a possibility where you could end up with large amounts of money coming your way for whatever reason, and that is when you will deal with an annuity where it's a designated amount that gets paid to you periodically instead of one large lump sum. Some common types of insurance that we will be discussing as we move through this unit will be health insurance, car or automobile insurance, homeowners insurance, and life insurance. But there are lots of different types of insurance: renter's insurance, especially for those that are renting and not homeowning, malpractice insurance for doctors, workers' compensation, and boat insurance, business insurance. There's just a lot of other options. disability insurance, even Social Security could be considered insurance, the way that insurance works. So lots of not so common types that may not apply to everybody, but most everyone has experience with health insurance, car insurance, homeowners, or life insurance. There are lots of reasons why insurance is important, and it varies really from person to person, but in general, it offsets your financial burden of risk. If something bad happens, the insurance company can pay for the repairs. Now, you will pay the insurance company those premiums, but even if you have paid the insurance company less than what the cost of the quote of the claim could be, the insurance company will still pay for it because you have that contract with them. There are instances when you need to buy insurance. Car insurance, when we go more in depth with that, 49 out of the 50 states require it, which means you cannot drive your car on the road unless you have car insurance for it. You will need your own health insurance by the time you're 26. Now, whether or not it's required that you actually have health insurance is different, but you cannot stay on your parents' health insurance past the age of 26. And most banks will not approve a mortgage without some sort of homeowner's insurance. Keeping your premium low really could be a lot of research on your behalf, which company is going to give you the best value for the coverage that you are looking for. And that's when the insurance agency or the insurance agent, especially one that covers multiple companies, could be very beneficial because they could be the one doing that research for you. But also on you, you could be the good student policy. A lot of the times will decrease your car insurance payments. If your house is built in a location and of solid material where it's just not as likely to experience fires or water damage or whatever the case may be, then your quote or your premium could be lower. Lots of different things, and maybe even credit scores could end up determining your premium to keep to cost high or low. So lots of things to consider. Don't just take something off of the internet just because it's cheap. You want to make sure that you are getting what you actually pay for. And so we will go further into insurances, different types throughout the unit.